Welcome, everyone. My guest today is Lead Analyst Logan Mohtashami to talk about the jobs data and how that impacts the 10-year yield and then mortgage rates. First, here's a word from our sponsor. This is Sarah Wheeler, Editor-in-Chief at HousingWire, with Ryan Marshall, CEO and founder of Equity Protect, to talk about a very specific and growing kind of fraud risk. Ryan, what is being done today about deed fraud?
So it's important to highlight here that this is a financial crime. It often targets unsuspecting lenders and new buyers, and it almost always involves a title insurance company who insures the transaction going forward, right? So this means that the unsuspecting lender or buyers always have title insurance, so they're oftentimes covered in the fraud. Who lies at risk are the lawful homeowners of the property because the named insured on that new title policy is the lenders and the buyers who acquired the property and not the persons that the fraud was committed against. So, for that reason, it's important for lawful homeowners to protect themselves. And so, we've really broken it into two categories that are available today. One is prevention and one is restoration. In most cases, the local governments and the state recorder office or the local county recorders offices are already offering free alert systems. So if somebody records a document, the moment that it becomes public, you get notified. In our scenario, we actually provide a preventative measure, making sure that that homeowner never falls a victim to having a deed or having a new mortgage placed on that property without their proper approval.
Thanks, Ryan. Listeners, you can find out more information at equityprotect.com. Logan, welcome back to the podcast.
It is wonderful to be here, Sarah.
We are recording this on Friday morning. We just got the labor data. What does this look like?
Good labor report. Headline was a beat, even though there's some seasonal quirks to it, but positive revisions. Wage growth is cooling down. And I think in a normal setting, this would be perfectly fine. But like we talked about, a few weeks ago, itchy fingers, right? As soon as the headline report came out, bond traders sold off the 10-year yield. 10-year yield spiked 12 basis points right off of that. And again, this is part of this dynamic for us talking about the labor market always goes back to the COVID-19 recovery model that we'll get all the jobs back that we lost to COVID by September of 2022. But, we have so much leeway make up labor demand until we get to like 157 to 159 million. We're just making up the trend. And I think that's the surprising thing for some people. Even if you do some positive revisions, all these things about the labor market, like breaking, just aren't true. And I always fall back to jobless claims. Jobless claims data for the last few months have been getting better. There's no time recorded in US history after World War II where the labor market is breaking and jobless claims data is getting better. It's never occurred once. So even if you want to take away the job openings data that came out big, job growth is slowing, but it's slowing like it should, right? Just because population growth where we are, we're getting back to normal. But I think the problem now is now that the 10-year yield has spiked up, any good labor report is just going to be pushed really hard right now. So I think that's going to be the issue going out in the future, is that any real positive data will be looked at in a negative way for housing just because the 10-year yield can break up higher.
Well, and this has been a wild week. So, how the 10-year yield is taking this information is also super important because we have had such a crazy week with the bond market.
It's part of not being a Fed pivot person was always the belief that the Fed needs, or not needs, but wants to attack the labor supply. But here's the problem with that theory. Wage growth has been slowing down, right? Wage growth has been slowing down by itself, even with a tighter labor market, even with jobless claims near 200,000. That was supposedly not supposed to happen. So I think the Fed has probably got themselves trapped here where the 10-year yield has gone against them. Real yields are very restrictive now, but the jobs data is just kind of pushing along. So they're kind of in a bind. Now, what happened this week is that you've had 4 Fed presidents Treasury Secretary Yellen talk about, hey, listen, we might not have higher. I think they're a little bit mindful of the 10-year yield spiking up. But if you focus on labor supply and this continues, you have to imagine the bond market is just going to go with it until the labor market breaks.
So, what is the Fed going to do? What can the Fed do right now? What could they do if they wanted to make the situation better?
They have to do what we've always talked about. They have to endure. And when you talk about enduring, that's something they should have done months ago. But when you're playing with fire and you say you want to attack the labor supply, and the data that you want to get worse isn't getting worse, it's getting better, you got a problem. If wage growth had been accelerating higher, that's a different equation, but it's not. Wage growth is slowing down. Job openings is still falling. It's just going to take time to get what they want unless you break the labor market. And I think that this is why targeting labor and wages, coming off of a COVID-19 situation where you're still in makeup demand with the balance sheets that we have in America, it's problematic in that sense. And that's always been the concern for many months, is that they don't know how to endure. And they've talked about, okay, we're restrictive on real rates now, and then the 10-year yield jumps on them. So in some ways, this might give them cover for what they want. They could probably come out and go, oh, the labor market's still strong, we need to be hawkish. But that just goes back to my original point. They want to break the labor market, and the labor market isn't breaking because they're still stuck in the 1970s model. And all these other data lines are going back to pre-pandemic levels, and their models told them it wouldn't. And this is the painful thing about watching an institution work off of the 1970s when it was a global pandemic, and the marketplace is just trying to work itself out, especially with shelter inflation. That they've started to talk about more and more, but I think that forward guidance from them put them in a box. I think it's going to be very hard for them to get out of it unless they kind of all unite, which most likely we're not going to hear anything until the Fed meetings. I mean, we literally had 4 Fed presidents and Yellen tried to hey, listen, everyone relax. But this is the honey badger labor market that we've talked about. And there's some structural dynamics that are different until we get back to 157 to 159 million people working, because that's where we should have been if there was no COVID. So just think of it as makeup demand. Job growth is slowing. It's going to slow over the next 12 months, but that would be perfectly normal with our population growth.
Really interesting that you bring up the fact that maybe it's their whole model that's broken, because you've been talking about this for a while, that this is not the 1970s, and if you treat it like the 1970s, you're going to come up with the wrong solution. And I think that's what I think we're seeing now, is that they weren't prepared for the way that this was going to work out.
I think when you focus on or think about wages spiraling out of control, and that too many jobs is a bad thing, it becomes a problem when you're in makeup demand. And this is why we write about this all the time. Makeup demand. If there was no COVID-19, we should be at 157 to 159 million. That would be normal. There's nothing actually wrong with that. That's just coming back to the long-term trend. And if you don't incorporate that in your own model, then you would think job growth is, the labor market is super hot, wages are out of control. Average hourly wages have been slowly moving lower since January of 2022. So the whole thing just blew up on their face. And this is the problem with going back to a time in history and thinking that we're going to do it this way. So I think I'd be very interested to see what they really think, because under these circumstances, with jobless claims almost at 200,000 again, you would have to see wage acceleration, and it's not occurring. And I just think this is just such a unique period that you have to give unique circumstances to there. This is why we're so detailed on our COVID-19 recovery model, on the labor market, the honey badger labor market, the job openings, 10 million. We adjust to the demographic profiles of the United States and just take the trend line of job growth and population growth. And looks kind of normal. So it's just more of an issue now when the bond market is in this stage. Itchy fingers, right? And in a sense, the soft landing that they want gets a little bit more problematic for them because the bond market is saying, listen, you told us you want to attack labor, so you're going to have to keep rates higher enough to attack the labor market. And it's unfortunate that we are here, but this is the path they chose. And that's the path the bond market has taken on them. That's the path the short-term rates have taken on them. And we just got to take the data one day at a time now. But it's the honey badger labor market for a reason. And this is why the whole we won't pivot, the Fed won't pivot, is based on the labor market and jobless claims data.
So, especially when you see 4 different Fed presidents and Janet Yellen coming out this week, it feels like they've lost control of the narrative and they don't know what to do. I mean, how do you interpret that?
I'm going to give you a really good example. President Daly of the San Francisco Fed basically said, well, bond yields right now is basically one rate hike. They're making stuff up right now. Okay, there is no bond yields rate hike model out there. They're just making stuff up when they get interviewed. And it's such a unique thing because before the Fed meeting, they'd kind of set everything up and said, listen, we're just going to keep things at bay because we're restrictive, and bond yields got up. And I wish I could just show them, guys, what the labor market is doing isn't doing a super hot labor market. It's just recovering back to a trend. And that takes some time. And it's a good thing. It's not a bad thing. Wages aren't spiraling out of control. This is not the 1970s. And this is, I know I pick on baby boomers, but it's just, there's a group of people in this country who are stuck in an old way. And we say this with the growth rate of inflation falling and the core aspect going to hit on the shelter side, but you don't have to break everything. Land the plane. But I think once that 10-year yield broke to those key levels, we're just in a different ball game right now. And everyone could have seen, what happened as soon as it drops whatever we close the 10-year yield at. We won't know because we're talking about this in the morning. But you could see how itchy the bond market is right now.
So let's talk about mortgage rates. We are on Friday morning, so we don't know exactly what's going to happen. But this week has already been pretty crazy and historic and, devastating to the real estate and mortgage industry. So are we going to hit 8 today, 8%?
I don't think we hit 8% today, but we're heading toward there. And again, the best case for 8% mortgage rates, we talked about this 16 months ago, is that the economy is firm, the labor market doesn't break, and the one sector that gets hit, oddly enough, the one sector that the Fed says is recovering is going to get hit even more. So again, my concern has always been, so far, new listings data has not taken another leg lower. It's still trending at the lowest levels ever in history, but it's a very orderly decline. And what we don't want to see is another new leg lower. Now, for active inventory growth, again, I'm still batting a 0 this year with rate. I mean, I was talking about, okay, we can get more active inventory growth with rates going higher towards 7%, but over 7%, we still haven't been able to pull the 11 to 17,000 out. So I'm just hoping that we just slowly get our stuff back, get inventory back to 2019 levels, and there's more balance in that. And in this sense, this does facilitate that, because when you're not a mortgage rate lockdown person like me, you fundamentally believe that higher rates can create more active listings, but it requires demand to get hit. And we saw that last year. But this year, we still haven't broken under 4 million existing home sales. That's going to happen, but the velocity is different. And that explains the slow growth of inventory this year.
And the home prices are directly tied to inventory, correct? So you don't see anything happening with home prices until that inventory gets better?
This is, it's interesting now that we're in October and the velocity of price cuts data, the percentages, is still lower than last year. And there's so many people that are trying to convince people that home prices are going to crash. But I always stress this: the educated class of our society reads And there's a group of people in the history of the world that don't read, that believe in burning books, that believe knowledge is not power. The manipulation of men in this country um, usually comes from that group. And what occurs is people think Americans are poor and uneducated, that they'll rush to the market and sell and cut, that that hasn't happened for a very long time. That only happens when you're a forced credit seller. So here, higher rates, more inventory, price cut percentages can continue. That's a very simple basic model. You can track this. That can occur. But this notion of people selling to be homeless when they're doing very good financially, I mean, you have to really think about the mental state of some men in this country that think that people who have two jobs, who are doing well, who have a very low housing cost, would purposely try to destroy their lives for no reason. And this is the issue. This housing cycle right now, what we're dealing with is very like hand-to-hand combat in mud. It's just this buyer versus seller, and the existing home sales market didn't have the monthly supply spike like the builders have. The builders sell their homes as a commodity, so the velocity of price cuts and inventory is so much slower this year, but rates are so much higher and housing is more expensive. I think there's where I can understand why that can be confusing, but I always go back to the original premise. It's just really rare to get under 4 million. We're going to get there, but the duration of it, and again, the economy stays firm. The Fed has kind of told us this. They're not going to pivot until the labor market breaks, at least. And in that context, you get the same trends that we've been seeing when rates were getting to 7, above 7, and now here we are again. And it should work. That higher rates creates, I mean, it should work. Higher rates, more inventory, price cut percentage. This should be the case. It just needs higher rates for longer in the duration. That's what we've always seen in the data. It's just this year has been so slow on a lot of the data fronts that I think it's confused a lot of people.
So, given what you've talking about the honey badger labor market, right? Do you think the Fed is ever going to accept just a normal labor market? From your perspective, we're just trying to get back to a normal level, right?
You know, wage growth getting back down toward 3%, job openings data getting back to 7 million, jobless claims 323,000 4-week moving on. These are things that I'm looking at because those are pre-pandemic levels. Now, the quits ratio is back to pre-pandemic levels. That's a big deal for them. But I think when all of those things get there, it's again labor supply, right? Labor supply, they want to grow. And I always harp on this. The wage growth is not accelerating higher, even in a tight labor market, right? So this whole fear of wages spiraling out of control, or inflation getting embedded so much into prices that wages have to compensate and go higher, this isn't here. If it was here, it's a different case. But again, they've done so much so fast, land the plane. I just think they went into this thinking 1970s, and it's 2023 pandemic recovery, and this is a little bit more difficult for them to kind of model out. But we harp on this again today. The labor market is tight in their eyes, and wage growth is cooling down, and the growth rate of inflation is cooling down, and they are not focusing on that so much. They're focusing on the labor supply, and that's again, that's an issue for the housing market in the sense that they're more focused on that than the housing market. The housing market is the sacrificial lamb. So we'll see again with the next Fed meeting, but again, everything is different now because itchy fingers, right? Itchy fingers is a problem.
Itchy fingers is a problem, especially if you're in mortgage and real estate. You can just feel like you are you're the bystander. Other people are pulling all the strings, making things happen, and you just have to react.
Yes, it's an unfortunate reality, but it's the reality that we're dealing with, and we just have to take again, this is why I focus jobless claims, jobless claims, jobless claims. Everything is around jobless claims data. And the one data that got better since July was jobless claims. And again, nobody cares. And it's just one of these things post World War II. I was trying to teach somebody this morning, that if you go at every single economic cycle, jobless claims has to break. We could sit here for 4 or 5 years and still have these same arguments, but until jobless claims break, everything changes, and that would require 323,000 on the 4-week moving average. We're 210 around there, so it's just not that kind of, the labor dynamics are so much different now.
So the next time that you and I speak, we will be on stage doing a live podcast together. But before that, you're giving your keynote at HousingWire Annual, and wow, it's going to be. You said you've just revamped the whole thing because of what's going on with mortgage rates.
It's, this is the first time where my whole presentation will work around the 10-year yield and the labor market and the economy first, because that's the issue, right? When I went on CNBC very early this year, I said the entire housing market moves around the 10-year yield, right? So that's the key, and we're at another stage of this a game right now when the 10-year yield broke above 4.25, and we have to give it and show it that kind of respect. So the whole presentation in Austin is going to try to dumb things down to an understandable economic cycle model and correlate it to what could be the possible effects, because this is different. Everything is different. The COVID-19 recovery is different. The labor market's different. The balance sheets are different. There's a lot of things that are different. We have to figure out, when does the real estate industry get some relief? Because it isn't the growth rate of inflation falling that's doing this. It's the labor market that's actually hurting real estate. And oddly enough, Sarah, one of the first articles I ever wrote for HousingWire before COVID hit was like, if the economy gets better, the 10-year yield can rise, and that was before even COVID. And some of the economic data was actually getting better early 2020 before COVID hit. But of course, the COVID-19, the whole market was focused on that. But if that wasn't the case, right, you can make a case that 10-year yield should have been rising. But that was a different lifetime ago. But here, labor market. And it's going to be a whole discussion about, when do we see some relief on the 10-year yield?
Looking so forward to that, and also looking to being on stage talking about the mortgage rate lockdown with you in person. I can't wait to meet a lot of our listeners.
Sarah, don't take it personally, but this is, it's not going to be it's not going to be pretty.
Listen, let me just tell you. Let me just tell our listeners what I asked you earlier this week. I was like, Logan, are you a good loser, or are you going to be in a bad mood if I beat you at this debate?
See, Sarah, I never get myself in a situation that I would know technically I would lose. So, and again, I always keep my really, really good stuff inside my chest.
Well,
like the secret data lines and things that I really, really focus on. I don't really talk about them too much. And this is where I try to get people into a debate that I know they can't win. And then all of a sudden, all these new variables come in that have never been discussed. And all of a sudden the person goes, wait, you're not going to have an answer for it. But again, this is all my work. Going back to 2010, credit channels run inventory channels. And the presentation will go over all of that. So I wish you luck. Don't take it personally, but this is the body of work on mortgage rates, credit channels, and inventory channels. And it's going to be a lot of fun.
I would say the same thing to you. Don't take it personally, right? Because we're gonna have the audience vote at the end. We will see what they think. Okay, we are out of time for today, but thank you so much, Logan. See you next week in person at HousingWire Annual.
See you soon.